Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market webinar. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. One last look at the disclaimer. Good Tuesday morning, Dima.
Good morning, Will. How are you?
Good.
Let me share my screen here. Good morning, everyone. And today what we'll discuss is relative performance. And the concept behind relative performance, it's an important concept in financial modeling, financial trading, even trading strategies, and that even looking at models that have not only relative performance but relative value. And the idea there is, well, how do we measure one security or an asset relative to another security that's somehow related, and that could give us important insights on its performance. Think about a stock that has volatility, and it could be up on a day, it could be down on a day, or on a week. It's moving around, but there's a lot of factors that can be influenced. And one is just the general market, right? The overall market. But how is it performing relative to the overall market? If the market is lower and the stock is lower, well, it could explain the weakness in the stock. It's just following the rest of the market. But how is it performing relative to that market? Is it, if the market is down, let's say 1%, and your stock is down 0.5%, well, on a relative basis, it's outperforming, right? Because on the day, yes, you lost 0.5% in your asset value, but the rest of the assets went down by 1%, right? So you could sell that and buy more of the others. So on the other way, what about if the market is up? If the market is up 1% or 0.5%, but your stock is up 1.5%. Again, yes, the market is up, but your stock is doing even better, right? It's outperforming. So we're looking at places. How do we measure that? There's different ways to measure it. There's no one right way. So we're just going to look at some examples of different metrics we could use to sort of get a insight how a stock is performing. So let's pick a stock. And let's look at, I don't know, let's look at Apple stock. I'm going to type in Apple here, and we come to this summary page, and let's hit this trading stats. So while I'm on the trading stats, I'm going to come down here, and here is a kind of just a quick view, a table showing us a relative performance. And this looks at a time frame. So let's say 1 day, a 2-week time frame, 1 month, 3 months, 6 months, all the way down, and it gives us the performance of Apple over that range. And we could compare that to what the rest of the market did. Okay, so based on what the rest of the market did, you could see that yesterday on a 2-week basis, 1 month basis, even 3 month basis, 6 months, even 1 year, it has been outperforming the rest of the market. So as we expand the time, it's been outperforming. And this is just looking at different time frames. We could also look at it on a daily basis. So we could get a little bit more stats on a daily basis. And this is here where it looks at its daily returns, and it measures how would it be on a daily basis versus SPY. So let's look at a 15-day. All right, so this is a 15-day daily returns. And the idea there is that if you reset your notional risk at the end of the day, every day, right? Not just hold the stock, but traded it based on, constant notional risk. In other words, at the end of the day, let's say you wanted to risk $1,000 worth of Apple the next day. Well, if you bought it in the morning and it went up, you'd have more than $1,000 notional in Apple, so you'd have to sell some shares to get back to 1,000. If it went down, well, now you own less than $1,000 worth of notional in Apple, so you would have to you'd have to buy more to have that $1,000 at risk. So if you reset that on a daily basis, right, and that's in trading, it's important because that's kind of how like hedging works. But let's say you reset that on a daily basis versus the SPY. What was the average return over, we'll measure it in 15 days, the last 15 trading days. How often did Apple go up versus the market, right? So we're looking at versus the overall market. So here we have some stats. If you did that over the last 15 days, then 67% of those days, it was profitable. Okay, so the stock went up compared to 53% of the days in SPY. So there were more up days in Apple than in SPY. What about the average return? So on average, you'd have some losses, you'd have some gains. We're resetting it. Keep in mind, like whatever notional we decide to risk on a daily basis, that's what we're resetting. Okay. So on average, Apple was a winner for 0.33%. Okay. Whereas SPY, you could see, was a loser in this time period. Here, this gives us the standard deviation of these returns. And it lets us know how volatile on a daily basis up and down was Apple, versus SPY. So it was more volatile. Standard deviation was 1.57 versus 0.71. Okay, so there's movement around that average. So it wasn't 0.33% every single day, because then there'd be no volatility, right? So that's what this is showing us, the volatility. So if we take that average return divided by its standard deviation, we get this Sharpe ratio, and this lets us compare the return as a unit of risk versus SPY. Okay, and obviously you want this number to be high, right? Higher than these other benchmarks. So this gives us now an idea that the performance of Apple on a relative basis versus the rest of the market. You could do that versus similar stocks. You could do that versus maybe the industry that you pick out, but this here starts us out versus the rest of the market. And here, this shows us what if you did it as a pair strategy of equal notional, long $1,000 worth of Apple versus short $1,000 worth of SPY on a daily basis. You rehedged wherever that ended up. You rehedged it. Could be 1,000, could be $100, 10,000, but it's equal notional at risk. So here it shows us that strategy is a pair of buying one versus selling the other, equal notional. So it doesn't look at its beta, but just whatever you're long in one stock, you're short the other stock, right? So what you did was you shorted SPY, and you took, let's say for $1,000, you took that $1,000 and you bought Apple, right? So you financed your Apple by selling SPY. How did that work out? So that was a winner 53% of the time for an average return of 0.37% with a standard deviation of 1.37 and that Sharpe of 27.4. So you could see that having that hedge or financing the purchase of Apple versus by shorting SPY performed better than just long Apple or just long SPY. Like that was because it had a better return than daily return than all of these, 0.37. It had a higher standard deviation than just SPY alone, but lower one than just Apple. And if we measured it as a average return versus unit of risk, it's 27.4% higher than all these two. So here it's shown us that Apple did outperform the market based on these metrics. And if we try to mitigate the Apple's volatility by hedging against the market, right? Just the market risk, that also outperformed over here. And then we could just tab here 30 days. So 30 days, we get a little bit of a different scenario here. Just long SPY looks like it did better. And over 90 days, just doing it in Apple alone outperformed. Okay, so this gives us a relative performance over different time days, but on a daily basis. So let's see a report kind of that we created that just shows us, well, here's a group of stocks that looks like it's outperforming the market based on, certain benchmarks that we set. So I'm going to go up here under stocks and these outperforming stocks. Let's click on that. And now we get this list of stocks. And over here, we see SPY. This will be the benchmark that we're measuring against. And what we're trying to do is do a relative performance first on comparing it over a stretch of time. So here's over 7 days, over 2 weeks, 3 months, 6 months. All right. So you can see here Alibaba was up 51% in the last 6 months versus SPY 6.9%. Over 2 weeks, Alibaba was up 15.9%, SPY is down 1.3%. So yesterday on the 1 day, it performed worse, but over these stretches, it outperformed. Okay. Then at the same time, let's do another test and see on a daily basis. And we do that because over a 3-month period, let's say, what can happen is the stock outperforms SPY, let's say, like in Alibaba, but it could have been one very big day that skewed it up, right? So maybe on a daily basis, it may not look the same as it outperforms, but let's say they had an announcement and the stock got repriced, let's say it was up, whatever, 100%, 200% in 1 day. And then since then it's been underperforming. So we'd want to know that as well. So that's why we look at daily statistics. Okay. So daily statistics over here over the last 15 days. So we're looking at the shorter term period, 15 days. How many up days did Alibaba have versus SPY? So you could see here that Alibaba was up 73% of those days versus SPY 53%. What about the average return? Um, why do we look at the average return? Is because the up days and down days, the magnitude of those days could be different. So we can't stocks when they could be up or they could be down, but the percentage moves, they could vary. The volatility to the downside, for example, could be so severe that even if you have, small up moves 9 out of 10 times, if you have one, the down move to the downside is so volatile that it all those up moves are irrelevant, right? On average, you would have lost. So let's look at the average return. So we could see here on average daily return versus SPY. All these outperform because SPY here is in a negative right now. And so you could see this is a list of stocks that outperformed based on these measures: 7-day, 2-week, 3 months, 6 months, and on a daily, last 15 days. More up moves than SPY, better average returns. And what about the standard deviations? So you could see that the standard deviation of SPY, it's an index, so it's not as volatile as an individual security. But if we take the average return versus that unit of risk, then we can just compare them. And right now, SPY is in the negative because it has average negative returns. But here, now we have a list of stocks that seem to be outperforming the rest of the market if we use SPY as our market benchmark on these measures. Okay, so that's how, and of course, you could measure in many more ways than this, but this is kind of a report that gives you those types of insights. So I think I'm going to stop right there for covering the relative performance.
Excellent, D. Great job as always. Thanks, everyone, for joining us. We have chameleons in different parts of the country right now, enjoying the warm weather of Arizona, to be specific. Everyone, thanks for joining. D, great job as always. Remember to like and follow us on YouTube. Great job, buddy.
All right. Thanks, everyone. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trade in peace, chameleon.